Hey, everybody out there. Once again, Mark Collingsworth of Very Global Financial Wealth Management because of today's rate hike by the Feds, another rate hike. And as you can see, I'm kind of dressed in my Christmas garb. Should I be happy? Is this a Christmas present because they only raised the rate 50% rather than
50.
an expected perhaps 75%? So it's less than it has been. So is that a Christmas present or not?
I'm going to say probably not. The reason why the stock market sold off very abruptly after the meeting and what kind of got people kind of unnerved was the statement that they're going to raise rates longer going down the road. Most people thought they'd do 50 here, maybe another 50, but based on what they were saying in the Fed meeting, you might get 50 now, 25, another 25, another 25. They're going to keep on raising rates. And in other words, they're going to keep raising rates until inflation is well under Fed funds rate.
Yeah, the speculation is throughout next year, they're going to have more increases, a series of rates, maybe only 25%, but still increases in rates. So, again, is that heading us towards a recession?
I think we're probably already locked into a recession. Um, well, I'll get to why I don't think we've had a recession yet, but I think we're locked into a recession. If you look at the 3 month Treasury bill yield, the 3 month Treasury bill yield is trading above the 10-year Treasury bond yield.
Yeah.
What that basically means historically, whenever that's happened, you've had a recession based on history. The earliest recession has been 3 months after it inverts. The longest has been 18 months after it inverts, and usually the average is around 7 months. So, based on when it inverted, somewhere around March, we should be in a recession based on history.
Which is actually good news, according to the Fed, to bring down inflation, correct?
Oh, yeah. When people start losing jobs in mass, they can't spend money, and that causes inflation.
And they're openly admitting that that's part of the plan to reduce inflation.
They kind of sugarcoat it. They say, we need to target demand. When they say target demand, what you're really saying is the consumer spends money because he has a demand. If you take money away from the consumer, in other words, taking his job away from him, he has no money. You're targeting his demand.
So more unemployment ahead, which is partly what they want, and
That's what they
more
want, but they haven't got it yet.
and more rate hikes. So actually now, with today's half a percentage increase, we're at the highest level in 15 years, correct?
That's correct. Yep.
And more to come.
More to come. And I think the reason why you haven't seen the economy slow more, and this is just talking from different people in different industry groups, a lot of that COVID money that came into the system, a lot of that money never got spent. It was just sitting there waiting for opportunities. And those people that have that extra COVID, and we're talking like, billions of dollars of COVID money, they're now starting to put it to work in projects, and that is starting to jumpstart new jobs and new job creation.
Now they're talking about a targeted rate between 4.25 and 4.5 of the interest rate hike. That's what they're aiming for at this stage of the game, correct?
Correct. Correct. And their goal based on the dot plot, sometime next year that number will rise between 5.5, I mean 5.25 and 5.5%.
Now, with that kind of an increase, can a recession be avoided? Because Powell, the Fed chairman, is saying, well, maybe it won't be a recession. Is that wishful thinking?
I mean, I'm sure he's looked at the studies on when you have an inverted yield curve. It's only one of two indicators out there that I know that has 100% track record of predicting recessions. And one of the indicators is already flipped. The other indicator, which is the 12-month moving average of unemployment, has not flipped yet. But once that one flips, you're locked in.
Okay, now so with today's action, the most recent rate hike, uh, it's kind of like openly accepted that there will be no reductions throughout next year, throughout 2024. Now, was that expected, and did that throw the markets into flux?
I think what threw the markets in a flux is they said that they'll be raising rates longer than normal, meaning that they might be smaller increases, but they're going to be smaller increases throughout the year, which I still think that's a bad decision because inflation is still relatively high. I mean, 7% inflation rate, that's going to be hard to get down, even if the Fed funds rate's at 5%. 5% Fed funds rate and a 7% inflation rate still doesn't go well together.
Well, Chairman Powell is saying that there's already indications that their strategy is working because we are getting a reduction in some prices in oil, gas, other products. So, is he being overly optimistic here? Is he giving a correct reading on the success so far that he says is apparent?
Well, let's not forget. Let's get a time machine and go back 2 years. All the stimulus money is not going to cause inflation. Then we got that's coming from the Federal Reserve. Then they came out and said, "Oh, the inflation is just transitory. It won't last very long." And now they've stepped back from that. So when they say it's not a problem, I look at it and say, "You don't have a clue to what you're doing. Why should I believe you anymore?"
They're talking about getting what down to 2 point something percent,
Yep.
2.5% in what, 2025?
Yeah, that's not going to happen either.
What do you think is going to happen?
The only way you can get down those targets is you're going to have a recession, and you're going to have to see some massive job losses. I think that's where the recession is going to start. The Fed's already probably done too much too fast, and they haven't let the economy digest it. One of the reasons why your unemployment numbers have looked so good here in the last month is because people are now starting to hire for the Christmas shopping season.
Right.
That's where all that job growth came. Come February and January, especially February, you're going to see massive job losses of all those people that were hired in October. Those people that were hired just for Christmas are going to lose their jobs, and the Fed's going to be stuck with massive job losses along with an economy that's going to start slowing exponentially.
Well, Mark, Biden keeps talking about the new job creation. A lot of that, I mean, in addition to the seasonal swelling of jobs, which goes down again after the season is over, these new jobs that he's talking about, they're really just returning to jobs that were shut down because of the COVID shutdown. So they're not really new jobs, are they?
That's correct. We have seen some actual new job creation, but the bulk of the jobs that have been created here over the past year and a half have really just been people returning to their old jobs.
So therefore, the signs of increasing recovery are largely exaggerated by Biden and even by the Fed.
Correct, because in um, November and December of 2007, I think the Federal Reserve knew they were in a bad situation with the housing market. They just couldn't hit the panic button, and they tried their best. They started cutting rates in March, but it was too little, too late.
How does the stock market react today with the announcement of a 25% rate hike?
The market was actually up. The Dow was up about 100 and something points, and it lost 300 points. So it was all over the place today, but it actually finished down negative. It recovered a little bit before the end of the day, but it lost. It went from positive to negative at the end.
And what do you expect to happen for the rest of the week?
Well, that's interesting because usually, historically, when you have the Federal Reserve meeting in December or the mid-December meeting,
Mhm.
that normally kicks off what's called the Santa Claus rally. So the last 2 weeks of the year, Santa Claus comes to Wall Street and he brings, great stock prices to everybody. So the next 2 weeks are really important. If Santa Claus does not come to Wall Street for this upcoming 2 weeks, historically that's a very bad sign for the upcoming year. Give you a perfect example. Go back to December of 2021 last year. Santa Claus didn't come to Wall Street, and look what happened this year.
Well, Mark, you're a financial manager, an expert, and you advise people on how to invest. So, what are you telling them these days with these continuing rate hikes and with the continuing uncertainty in the economy of the United States? What do you tell them to do?
Several things. Uh, Keep some heavy cash. And right now, you can go out and buy a 1 month T bill and get over 4% interest on a 1 month US T bill, which is a great that beats living daylights in our bank account. And even then, I mean, look at value. You've got stocks out there that have actually done better than your Amazons and your Apples, but people just ignore them. Tech stocks, people always think tech. Oh, well, the world's tech, tech, tech. No, the world's not tech. The world still has to run on energy. The world still has to run on food. There's tons of things out there that you can buy that's outside of the tech spectrum. I mean, if you avoided tech stocks this year, and you stuck to like your traditional Warren Buffett stocks, you're probably up about 10% on the year.
So, therefore, your advice succinctly is what for those who are trying to figure out what to do with the stock market and other investments?
My best advice: don't chase fads. Don't get in these stupid tech stocks. You don't. If you like Peter Lynch said, if you can't explain how what a company does to a, a 2-year-old, you probably shouldn't be investing in it anyway. And it makes a lot of sense. Or better yet, as Warren Buffett used to say, you should invest in a company that any idiot can run because someday an idiot will be running it.
I guess good advice. Anyway, all right, Mark Collingsworth of Their Global Financial Wealth Management. Thanks again for the latest update on how the economy is headed, where it is now, and what the real story is. Mark, thanks a lot.
I'm glad to be here. And like I always say, it's always the darkest before things get really freaking bad.
What a optimistic note to end on heading into Christmas. Thank you very
Yep.
much.
You're welcome.